Here, an options trade can turn your fixed income into freedom income. But if there is a lack of proper attention, this options trade can also devour your dreams. Understanding Options is a book that explains the complex world of options trading in simple language. The author is Michael Sincere, who has written about finance and trading for the Wall Street Journal and other major platforms. He writes in a language specifically with new investors in mind, which every level of trader can easily understand. In this video, we will learn how call and put options work, how to manage risk, and most importantly, how to start options trading like a professional. So, let's begin this journey of trading knowledge. Chapter 1. When we talk about the stock market, most people only think about buying and selling shares. But there is another level to this game: options. The world of options trading, as complex as it seems, is equally powerful and profitable. But for this, one needs not just information, but proper understanding. That understanding is provided in this book in a very clear, simple, and accurate language. This chapter serves as the introduction to that understanding. To understand options, it is essential for us to first know that it is a trading tool that gives you more control with less money. In simple terms, an option is a contract that gives you the right to buy or sell a specific stock at a specific price until a specific time, but it is not mandatory to buy or sell. The difference between this right and obligation is what sets options apart from other types of trading. There are two types of options: call and put. A call option gives you the right to buy a share at a specific price in the future. On the other hand, a put option gives you the right to sell a share at a specific price in the future. These two options give you flexibility, especially when the market is volatile and risk is high.
Now, think for a moment. Suppose a stock's current price is 100 rupees and you think it will go up to 120 rupees in the next month. If you buy the stock directly, it will cost you 100 rupees. But if you buy a call option, you might gain control over that stock for maybe 5 rupees. And if your prediction proves correct, a small investment can turn into a big profit. This is the real magic of options trading's leverage. The author makes one thing clear here. An option is not a magic wand. It's not a shortcut, but rather a powerful strategy to be used with prudence, practice, and proper risk management. Many people lose money in it simply because they jump in to become Arjun without understanding it. But here the war is not about shooting arrows. It is about acting with a sharp mind and patience. Another important word in the world of options is premium. This is the price you pay when you buy an option. That is, the cost of the call or put contract you take is called the premium. If the option becomes worthless, only this premium will be your loss, not the entire stock value. This is a major advantage of options trading. The risk is limited, but the reward can be unlimited. Now let's talk about strike price and expiry. The strike price is the specific price at which you can buy or sell that stock, and the expiry is the date until which this contract remains valid. From here, a unique aspect of time comes into play with options: time decay. This means the value of the option decreases with each passing day. This is why having correct timing is most important.
The author says that most new traders ignore these subtle points and think that they just need to buy a call to make money. But the truth is that the value of an option is not just determined by the stock's movement, but also by many other factors, such as volatility, time decay, and demand supply. Therefore, it is very important to understand these factors well before buying or selling any option. Another important point the author has made is that the real profit in options happens when you use it not just for direction, but for strategy. That is, buying a call or a put is not everything. Sometimes by combining two options, you can reduce your risk and manage your returns. We call this an options strategy. We will discuss these strategies in detail in the next chapter. In this first chapter, the author gives us a perspective that changes our way of thinking. He says not to consider options just a gamble or a bet, but to understand it like a science, like an art. So this chapter opens the door to the world of options trading, where there are opportunities to earn money, but only for those who are ready to learn and understand. In the coming chapters, we will learn how you can not only understand options, but also master them, just like a trading warrior. Chapter 2. When you first step into the options market, it seems like a mysterious puzzle. At every turn, there are new words, new strategies, and strange charts. But in this chapter, the author tries to explain that if you can move beyond these basic words and tools, you can succeed.
Another important aspect of options is the expiry date, which is the date when the option will expire. It's just like a milk carton that has an expiry date. If you don't use the option at the right time, its entire value can be lost. It's a race against time, where every day is valuable. A new word comes up here. When you buy an option, you pay a premium for it. It is the type of price you pay for buying the possibility. Think of it this way. You are buying a lottery ticket. You know you have a very low chance of winning, but if you do, the profit can be big. Options are also somewhat like that. The only difference is that here, calculation and strategy work more. Delta, gamma, theta, vega. These are some Greek letters that have special significance in the world of options. But for now, just understand that they all indicate how the value of your option will move. For example, theta shows how much the value of the option will decrease with time. It is important to understand that the value of an option is not only changed by the stock's movement, but also by time and volatility, which play a big role. Volatility, meaning fluctuation, is the bloodline of options. Options on a stable stock are cheap because the probability of their value changing is low. On the other hand, options on a fast-moving stock can be expensive because the risk and reward are both higher. Now, let's connect it to a real-life example. Suppose you have heard that a tech company is bringing a new innovation. You think its stock will go up, but you don't want to take the risk of buying the entire share. In such a situation, you can buy an option with a strike price of 100 rupees. The author introduces you to those words and concepts one by one, which initially seem intimidating, but as you continue to read, that fear decreases and confidence starts to build.
The purpose of teaching options is just this, to get you past that first wall that keeps most people away from options. The author repeatedly reiterates one thing: options are not just a gamble. They are a calculation, a strategy, a way of thinking. If you understand it correctly, it can give you extraordinary power. But if you use it without understanding, loss is guaranteed. So always start with the basics. Don't move forward until you fully understand calls and puts, strike price, expiry, and premium. Because this is the foundation on which your options trading building will stand. And yes, if you think that all this is just theory, then you are wrong. The author himself has learned from his experience how great successes are hidden in these small words. All that is needed is to understand with attention, practice with patience, and make the right decision at the right time. So let's move forward now to where this understanding will become profitable for us in a practical way, to the world of option strategies. Chapter 3. Have you ever wondered how some people in the market consistently make money when others are just guessing? The answer lies in one specific thing: understanding options pricing. And this understanding doesn't come overnight, it comes gradually through a system. In this chapter, we will talk about every aspect that creates the value of an option, that separates a professional trader from a regular one. Whenever you buy an option, say a call option, you are buying something whose value is made up of two parts: intrinsic value and time value. Intrinsic value is straightforward. If that call option is in the money, meaning its strike price is below the market price, then it has real value. But time value, in simple terms, is the value of hope. The more time that is left, the more potential there is for the price to move, and the higher its value.
The thing to understand is that most people ignore time value. They don't understand how the value of an option decreases with time. This is called theta decay. Suppose you took an option that expires after 30 days. Its value decreases with each passing day, even if the stock price doesn't change. And this is the thing that causes the most loss for new traders. They take an option and think that something will happen, but nothing happens, and time quietly pulls money out of their pockets. A big thing has been said here. An option is not just a bet on direction, it is a bet against time. And when you are betting against something that works against you every second, your strategy needs to be clear. This is why professionals don't just look at time, they also look at volatility. IV, which stands for implied volatility, tells you how much instability the market expects. When IV is high, the value of the option gets inflated, and at such a time, the seller benefits more. On the other hand, when IV is low, the buyer can enter at a cheaper price. Now you might be thinking that these are all technical things. What do they have to do with my life? Let me give you a simple example. Suppose you are buying an umbrella during the rainy season. At that time, the shopkeeper increases the price of the umbrella because he knows that people are ready to pay more now. The same thing happens with options. When there is volatility in the market, IV increases and options become expensive. This means that your entry can be wise at a time when others are scared, but only when you understand that time and volatility are on your side. This is why the author repeatedly emphasizes that you ask yourself 3 questions before buying or selling any option. 1. Am I confident about the stock's direction? 2. How much time do I have for this movement? 3. How much movement is the market expecting? If the answers to these 3 are not clear, then options trading becomes a guess, and in the market, guesses are mostly proven wrong.
Now, let's talk about delta. Delta is a meter that tells you how much the value of the option will change with every $1 movement of the stock. If your call option's delta is 0.50 and the stock goes up by $1, the value of the option will increase by 50 cents. Simple, right? But its special features don't end there. Delta also tells you that it becomes important when the stock moves quickly. Because as the stock's direction changes, the delta also changes. And if you are not prepared for this, you can make a wrong calculation. Another neglected aspect is vega, which tells you how much the options value will change with every 1% change in IV. And this is the reason why the value of an option sometimes falls quickly, even if the stock stays in the same place. And finally, there's rho, which people often ignore. It shows the effect of interest rates. When interest rates in the market increase, the value of call options can increase slightly, and the value of put options can decrease. Now look, if you take an option without understanding all this, what did you do? You made a deal where you yourself don't know why the price is going up or down. You were just relying on charts or tips. And this is the difference between a regular trader and a professional options trader. The essence of this chapter is that the value of an option is a living thing. It moves on time, direction, hope, and the pulse of the market. In the options market, volatility or fluctuation is a force that can either lift you up or bring you down. In this chapter, we will talk about that volatility which many people are afraid of, but intelligent traders use to their advantage. There are 2 types of volatility in the market: historical volatility and implied volatility. Historical volatility means past fluctuations, and implied volatility means the trader's expectation of how much the market will move. The author says that most new traders do not understand the difference between these 2, and this is why they make big mistakes in their decisions. Implied volatility is the prediction that the market itself is making. For example, if the premium of a stock's option is very high, it means the market is expecting a fast movement in that stock.
From this, we can understand whether an option is cheap or expensive. The author says that volatility is a mirror that shows the market's true intention. Now for an important point, vega. It's part of the options Greeks that says how much the option's value will change if volatility increases or decreases by 1 unit. For example, suppose you have bought an option whose vega is 0.10 and volatility increases by 20%. Then your option's value will increase by 10 paisa. If you have traded in the right direction at the right time, even this small change can bring you a good profit. But stop here. Don't get too excited after hearing all this, because volatility is a double-edged sword. When you buy an option, your hope is that volatility will increase. But if you sell it, i.e., write the option, it is a danger signal for you. The author repeatedly warns that if you ignore implied volatility, options trading can turn into a gamble for you. Now let's talk about another misconception, that more volatility means more profit. But the reality is that with more volatility, there is also more risk. When the market moves more, it scares most people, and decisions made out of fear are often proven wrong. In trading, one should not only look at the upward or downward movement, but also look at the truth behind this movement. So whenever you enter an option, be sure to understand volatility before that.
Is the option cheap or expensive? Now, is the market really going to move, or is it just for show? If you learn to read volatility, then consider that you have understood the most difficult language of options trading. And now comes a very important tip, IV rank. This means at what level the current implied volatility is compared to the last year. If the IV rank is 80, it means that the volatility is very high. At such a time, selling options can be profitable because the premiums are expensive. And if the IV rank is 10, then buying an option can be a good alternative. With this small piece of information, you can avoid taking unnecessary risks. Not only this, but the author also says that a good trader is one who thinks before entering any trade. Do I want to be in this situation? Is this a truly wise deal? Because trading is a business, not an emotional roller coaster. You have seen that during times of volatility, rumors spread in the market, the media creates an atmosphere of fear, and traders lose their knowledge. But if you put your emotions aside and only look at the data and volatility, you can stand out from the crowd. And this standing out is the key to real profit. As you start to understand this world of volatility, you will see that there is no fear in it, just a lack of information. Once you understand this, you can turn that same volatility into a wave of profit, which people are afraid of. So the next time you look at an options chart, ask it, what are you showing and what is hidden behind you? Because the real victory happens where people don't try to look. Chapter 5. Making Money in the Stock Market. Making money in the stock market isn't just about luck or some secret. It's an art that can be learned with the right mindset, patience, and knowledge. Chapter 5 of Option Trading delves deeper into this art, explaining how to make the right decisions as a trader, enter and exit at the right time, and make your trading profitable and sustainable.
This chapter begins with a crucial point. Buying an option is easy, but buying the right option is an art. When you anticipate a stock's movement, you must look beyond the surface and understand what's hidden in the option's strike price, expiration date, and premium. The author states that the premium isn't just a price, but the essence of the market's hopes and fears. A trader must understand they're not just buying a stock, they're showing conviction in that stock's direction. And this conviction is time-bound. Therefore, selecting the right time, identifying the correct direction, and trading at the right strike price are all essential. The author says you shouldn't just think about how far it will go, but also when it will get there. Many new traders identify the right direction, but suffer losses due to a miscalculation of time. So make time a character in your strategy, not just a backdrop. Next, the author talks about option Greeks: delta, gamma, theta, vega, and rho. These are like 5 characters hidden in the soul of an option. Delta tells you how much your option's price will change for every $1 movement in the stock. Gamma explains the change in delta. Theta tells you how much your option's value will decrease as time passes. Vega shows the effect of a change in volatility on your option. And rho shows the effect of changes in interest rates. Many traders find these Greeks complicated, but the author suggests that if you only understand delta and theta, your strategy can improve significantly. Let's illustrate with an example. Suppose you buy a call option with a delta of 0.5 and a theta of 0.03. This means that even if the stock doesn't move, you will lose 3 cents per day as time passes. If the stock goes up by $1, your option will increase by 50 cents. The author advises you to always ask yourself a question when buying an option. Am I fighting against time or moving with it? If you're buying a cheap out-of-the-money option on a slow-moving stock with an approaching expiration date, you're fighting a war against time that will ultimately exhaust you.
Now, let's talk about strategies. Option trading isn't just about buying calls or puts. Sometimes, when the market direction isn't clear but movement is expected, strategies like straddles and strangles can help. For example, in a straddle, you buy both a call and a put at the same strike price. If the stock moves significantly up or down, you can profit. However, the author warns that these strategies should not be chosen lightly. You should consider the market's mood, volume, and open interest. These signals tell you how much money people are putting into trading and which direction they anticipate. The author also teaches in this chapter that you should not just look at the reward, you should first look at the risk. This is the mindset of a serious trader. People who only think about profit get stuck, but those who first limit their losses are the ones who ultimately survive and make a profit in the market. And finally, a very important point. There is no place for emotion in trading. The author says that when you buy an option, it's not a lottery ticket. It's a data-driven decision. The more you research and understand the Greeks, the less you will fall into the traps of fear and greed. So, the summary of this chapter is this. Option trading isn't just about direction, it's an all-in-one package of time, value, and emotion. And the person who understands and handles this package is the real player. Option trading is not a game. It's a mindset that teaches when to wait, when to attack, and when to retreat. The market is a place where decisions change every second and a new opportunity is created every second. But have you ever thought about the most essential thing to survive these moments? The answer is mental discipline. Success in option trading only comes to those who control their emotions, trust their decisions, and take every step with focus. In this chapter, we will talk about mental discipline in option trading, the inner strength that gives you confidence behind every decision. This is not a common topic. It's the foundation of your entire trading journey.
The author says the best traders aren't those who understand charts the most, but those who understand themselves best. When the market fluctuates, most people panic. They break their systems and make emotional decisions. Sometimes they exit too early due to fear, or they hold trades for too long due to greed. But a disciplined trader recognizes these emotions and learns to control them. Now, let's talk about one of the most common mistakes, overtrading. This happens when a trader constantly tries to do something in the market, even when there are no clear signals. This habit leads to losses. You must understand that it is not essential to follow every move. Sometimes waiting is the greatest courage. The second important point is revenge trading. When a trader immediately takes another trade after a loss to make up for it, it's an emotional decision where logic has no place. The author considers this one of the most dangerous habits because it not only increases losses, but also breaks self-confidence. Now, an important tool, the trading journal. A disciplined trader always notes their trades, when they entered, why, where they went wrong, and where they were right. When you start writing down your decisions, you begin to understand yourself more deeply. Your mistakes come to the forefront, and you learn to avoid them next time. Here, the author makes another profound point. Measure success not by money, but by discipline. If you have traded according to your rules, even if that trade resulted in a loss, it was a successful trade. But if you made a profit by emotionally breaking the rules, it was a failure because there was no solid thought behind that profit. Now, let's talk about mentality. In option trading, having a probability-based mindset is crucial. You must view every trade as a probability, not a certain outcome. For instance, it's not like gambling, but a win isn't guaranteed every time. Similarly, it's not essential to be right every time in trading, but it is crucial to adopt a strategy of making the right decisions in the long run.
The next important point is to accept losses. A good trader knows that losses are a part of the game. They don't take it to heart, they learn and move on. But a new trader often starts questioning themselves as soon as they suffer a loss. Pause for a moment after every trade and think about how you felt. Were you worried? Did you exit too quickly out of fear? Or did you delay out of greed? The answers to these questions will help you connect with yourself. When you start to understand yourself better, you improve your trading decisions, and this is the most profound lesson of this chapter. It is difficult to defeat the market, but understanding and controlling yourself is the real victory. So the next time you sit in front of the trading screen, don't just look at the charts, also look at your emotions. Are you calm? Are you following your plan? Or are you getting carried away by emotions? Because this determines whether you are a beginner or a professional. Chapter 7. Trading Psychology and Emotional Control. Imagine you are in an environment where everyone's eyes are fixed on a screen and millions of rupees are being traded every minute. In this high-voltage environment, one small mistake can ruin your entire plan. Which is why in this chapter, we will talk about the most important part of this entire game, trading psychology and emotional management. When you do option trading, it's not just a game of charts, candles, and data. It's also a game of the mental state in which you make decisions. Sometimes a trader who has learned all the technical tools still loses continuously because their mind is either immersed in fear or carried away by greed. The author says that fear and greed are the two biggest emotions that force us to make wrong decisions. When the market goes up, we think it has become a rocket and we run after the trend. But when the market goes down, we exit too early out of fear, whether it's a profit or a loss. Option traders make the most mistakes at these 2 points.
In this chapter, the author advises us to keep a trading journal. It's not a regular diary, but an autobiography of your trading. It clarifies every trade and process. Many times, we think we are trading with logic, but the journal shows us that we are actually trading with emotion. Here, the author talks about pre-trade mindset. When you start trading, are you relaxed or are you anxious to get revenge for a previous loss? All of this affects your ability to make decisions. This is why the same strategy works for one trader but fails for another. The author also explains that acceptance is very important in trading. When you accept that every trade will not be successful and that losses are a part of the game, you can move forward with a calm mind. But the moment you become stubborn about winning every time, you reach the brink of losing every time. This mental balance is the key that sets long-term traders apart.
In addition,
A very interesting point is made in this chapter. Do not link position sizing with emotion. Many times, we're so confident in a trade that we put a large amount of money into it while we put a minimal amount in another trade out of fear. But professionals don't do that. They set their risk management beforehand and stick to the rules, keeping emotion aside. Another point that is repeated is the trap of overtrading. Many traders think that trading more will lead to more income. But in reality, emotion is hidden behind every trade: boredom, excitement, or the pressure to compensate for a loss. The author advises that unless you have a solid reason, stay away from trading. The market opens every day, and opportunities will come again. Finally, a point is made in this chapter that seems simple but is actually very profound. Your biggest enemy is not the market or another trader, it is your own mind. If you can calm your mind and trust your strategy, that inner strength can become your greatest asset. So, whether you are a beginner or an expert, if you have conquered your mind, consider that you have won half the market game.